Margins have performed better than expected. That's thanks to both banks actively managing their balance sheet, but also thanks to a steeper yield curve. And that's a great environment for banks to operate in. So 2025, it's been a complex year. Political and top-down macro uncertainty has certainly continued, but it's also been a really great year in terms of validating our core thesis on the financials, particularly in Europe and in the US. In Europe, it's been another strong year for the banks, but I think the outlook remains very bright. We've talked about it for a while, but this year we've actually started to see a re-rating of the sector. Valuations have moved from around 7 times at the beginning of the year to around 9 times earnings today. But crucially, it's not just been a re-rating. We have seen earnings momentum continue through the year as well. And if we look at 2027 earnings estimates, they've been revised about 20% higher through this year. The other good thing is that the drivers of those upgrades have been pretty broad-based. And it's been really reassuring to see some of the proof points coming through on our thesis of what happens as rates come down. So, margins have performed better than expected. That's thanks to both banks actively managing their balance sheet, but also thanks to a steeper yield curve. And that's a great environment for banks to operate in. Meanwhile, volume growth has also been steadily recovering throughout the year, and that's despite the backdrop, not really being the most conducive. And then if we look at fees, fee-led activities like insurance, investment banking, they've continued to do well. And we've also seen both costs and provisions remaining very controlled and contained. And certainly the lack of any substantial credit growth in recent years in Europe is a very strong underpin for asset quality. So we see that environment sustaining into 2026. And that's what really makes the European bank sector stand out. At 9 times, it's still one of the cheapest sectors, and it compares to the broader European market on around 13 times 2027 earnings. And it's also one of the few sectors that's actually seeing meaningful positive earnings revisions. If we look year to date at the broader European market, that's actually seeing downgrades. I think it's also very important not to overlook the compounding effect of book value growth and attractive dividend yields in terms of what that means for value creation. So one way to look at it is if we strip out the dividends that are set to be paid by the banks between now and the end of 2027, alongside the excess capital that could reasonably also be distributed, then that headline 9 times PE actually drops to something closer to 7.5 times. So we still think there is value looking ahead into 2026, even if greater selectivity will be required. If we turn to the US, the economic backdrop has remained uncertain. We've had roller coasters of sentiment around the impact of tariffs, around AI, and around private credit. However, there's also been a very favorable bottom-up driver for the banks, and that has been the theme of easing regulation. And we're particularly focused on how that will feed into M&A. We do think that we're just at the beginning of a multi-year consolidation story. And crucially, we're seeing the proof points again coming through. So we've seen deals being announced this year. We've also seen the regulator moving more quickly in terms of signing those deals off. So that's a key theme that we are laser focused on looking into 2026 as well. And that clearly plays to the strengths as an active and specialist manager.